Oh, look at you, choosing the IAS 16 cost model. How brave. This is the accounting equivalent of wearing beige underwear for the rest of your life because you're terrified of excitement. Here is the deal. You buy a building, it costs you $1 million. 10 years later, that building is worth $5 million because a hipster coffee shop opened downstairs. Does the cost model care? No. The cost model is an emotional brick wall. It looks at that market appreciation and says, I don't see it. You carry that asset at what you paid, minus the slow, painful decay of depreciation. It is willful ignorance with a calculator. You are literally staring at a pile of money and writing nope in your ledger. Why do we do it? Because the alternative is the revaluation model, which requires hiring expensive consultants to guess what your warehouse is worth. Stick to cost. It's safe, it's boring, but if you forget to deduct the accumulated depreciation, I will personally come down there and audit your lunch expenses. Oh, so the cost model isn't exciting enough for you? You want to use the revaluation model? Congratulations, you are a narcissist. This is the Instagram filter of accounting. You take a boring old building and try to make it look hot and expensive. Here is how it works in Fantasyland. You hire an appraiser, who charges a fortune, by the way, to guess what your asset is worth. If the value goes up, do you get a profit? No, you get a revaluation surplus. It goes into other comprehensive income, or OCI. That is the friend zone of accounting. It sits in equity, looking pretty, but you cannot touch it. You cannot pay dividends with it. It is ghost money. But if the value goes down, oh, suddenly it's real. If it drops below the original cost, that hits your P&L as an expense immediately. You take all the risk of the loss, but you get none of the fun of the profit. And once you start revaluing, you have to keep doing it. You are trapped on a hamster wheel of constant appraisals. Stick to the cost model, or I will revalue your employment contract to 0.